Flexi Cap funds are the most popular mutual fund category among investors. Their popularity is evident from the inflows over the last 12 months. The category has garnered inflows of 1.01 lakh crore in the last year, the highest among diversified fund categories. Now, within this category, two funds stand out for their size, reputation, and strong investor following: HDFC Flexi Cap Fund and Parag Parikh Flexi Cap Fund. HDFC Flexi Cap Fund has seen a substantial improvement in performance in recent years, especially after it was reclassified as a Flexi Cap Fund and experienced a change in the fund manager. In July 2022, Roshi Jain took over the fund's management following Mr. Prashant Jain's exit, the long-serving and well-known CIO of HDFC Mutual Fund. Now, taking charge of a fund managed by one of the most respected names in the industry was no small task, but Jain has done well to bring the fund back into the spotlight with better returns. On the other hand, Rajiv Thakkar has managed the Parag Parikh Flexi Cap Fund since its launch. After Mr. Parag Parikh's unfortunate passing in 2015, Mr. Thakkar had the major responsibility of continuing the fund's journey. He handled this challenge with steady leadership and long-term thinking, which helped maintain investor trust and keep the fund on track. So, which of these stalwarts is truly the better fund? That's a question investors increasingly find themselves asking, especially as both funds have charted distinctive paths over the years. Now, in this video, we'll present a comprehensive, data-driven face-off between the two. We will break down everything from trailing and rolling returns to risk-adjusted performance, downside protection, portfolio strategy, and top holdings. By the end of this analysis, you'll have a much clearer understanding of how these two market leaders compare and which one might be better suited for your investment goals. But before we proceed, a quick disclaimer. These funds are not our recommendations. The idea is to give you all the key details so you can pick the fund that is right for you. Alright, let's begin by knowing the two Flexi Cap funds a little better. Flexi Cap funds must invest at least 65% of their assets in equities. However, they don't have any market cap or sector restrictions. So Flexi Cap funds give fund managers the flexibility to invest across large, mid, or small caps as per their discretion. Now, HDFC Flexi Cap Fund is one of the oldest funds. It was originally launched in January 1995 under the name HDFC Equity Fund. For many years, it was a flagship offering from HDFC Mutual Fund. Now, in July 2020, following SEBI's mutual fund reclassification, the scheme was renamed HDFC Flexi Cap Fund. Now, while the fund's name changed, its investment mandate remained largely intact. Fast forward to April 2025, and the fund manages 74,105 crore in assets, making it the second largest fund in the Flexi Cap category and the third largest actively managed equity mutual fund in India. Now, on the other hand, Parag Parikh Flexi Cap Fund is a relatively new entrant, having been launched 12 years ago in May 2013. However, it holds a distinct position in Indian mutual fund landscape. It is both the largest Flexi Cap fund in the country and the largest actively managed equity mutual fund across all categories. It manages assets worth over 1 lakh crores. Okay, let's now begin the actual face-off between the country's two largest Flexi Cap funds. And first things first, let's start with the performance and the returns. The trailing returns of these funds, category, and benchmark are on your screen. As you can see, in 3 and 5 year returns, HDFC Flexi Cap Fund has performed much better than Parag Parikh Flexi Cap Fund. Its 3 and 5 year returns are 28.11% and 33% versus 24 and 29% of Parag Parikh's. However, the picture is different when you look at the 7 and 10 year time frames. Here, Parag Parikh has done better with 20.7% and 18.24% respectively, whereas HDFC has delivered 18.5 and 16.39% in the 7 and 10 year periods respectively. Now, the strong performance of HDFC Flexi Cap Fund in recent times is the classic turnaround story, which the new fund manager seems to be scripting. Now, both these funds have comfortably outperformed their benchmark and category average across all time frames. Alright, let's now look at the rolling returns of these two funds to see how consistently these funds deliver. On your screen are the 5 and 7 year rolling returns of both these funds and also of their category average and the benchmark. Parag Parikh Flexi Cap fund, with its 5-year and 7-year average rolling returns of 19% and 18.94% respectively, has outpaced both the category and the benchmark with a wide margins. The performance of HDFC Flexi Cap fund was, however, in line with the category's average in both the 5 and 7-year periods with approximately 15% returns. But the fund has comfortably outperformed its benchmark, the Nifty 500 TRI. So it is evident that the younger contender, Parag Parikh Flexi Cap fund, has comfortably outpaced its older counterpart, HDFC Flexi Cap fund, in terms of overall returns. But as we saw in the case of trailing returns, how HDFC Flexi Cap fund has outshined its younger peer in the recent past, we wanted to see if that's also true for short-term rolling returns as well. Though we don't use rolling returns for a shorter period, in this case we will check them as HDFC Flexi Cap fund turnaround story is recent. So on your screen are the 1 and 2-year rolling returns rolled on a daily basis over the last 3 years. Now we've taken 3 years because Ms. Jain took over the fund in 2022. With a 1-year rolling return of 25% and 2-year rolling return of over 26%, HDFC Flexi Cap fund has clearly outpaced Parag Parikh Flexi Cap fund, as well as the benchmark with a wide margin. Parag Parikh Flexi Cap fund has given 1-year rolling returns of 19% and 2-year rolling returns of 21%. What's even more interesting here is the minimum returns column. While both Parag Parikh Flexi Cap fund and Nifty 500 have generated negative minimum returns in the 1-year period, HDFC Flexi Cap fund has outperformed them with a positive 4% return. In the 2-year time frame, the minimum returns for HDFC Flexi Cap fund are way higher at around 12% versus the benchmark's 4% and Parag Parikh Flexi Cap fund 6%. So just like trailing return, HDFC Flexi Cap's turnaround story after the new fund manager has taken over is validated in rolling returns as well. But what about the risk? Could this impressive performance be a result of higher risk taking? In the next section of the video, we will go deeper to assess the risk profile of both funds. Standard deviation is a measure of the volatility of a fund. The higher the standard deviation, the more volatile the fund is, and vice versa. So let's begin with the standard deviation of 5-year rolling returns. HDFC Flexi Cap fund has the highest volatility. Its standard deviation is 6.16. For Parag Parikh Flexi Cap, it's 5.11. Now in the medium term, both funds have higher volatility than the category. However, in the long term, the picture changes. HDFC Flexi Cap standard deviation is 2.69%, whereas for Parag Parikh Flexi Cap, it's 1.6%, which is lower than the category average of 1.89%. But the risk is not only defined by volatility. The true measure of risk lies in understanding how a fund performs during the periods when the stock markets correct. Now in the next segment of this video, we will examine the fund's performance during challenging market conditions. Parag Parikh Flexi Cap fund was launched in May 2013 with quarterly performance data available starting from September 2013. Now for this analysis, we have considered the last 47 quarters, which represent the maximum period available for a meaningful comparison. Among these 47 quarters, the broader market benchmark, the Nifty 500 TRI, registered negative returns in 15 quarters. During these periods, the HDFC Flexi Cap fund fell less than the benchmark in 7 quarters, whereas Parag Parikh Flexi Cap did better in 11 quarters. Notably, out of these 11 quarters, the Parag Parikh Flexi Cap fund posted positive returns in 6 quarters. In contrast, the HDFC Flexi Cap fund was positive in only 2 of those quarters. Now, this strong performance clearly shows the Parag Parikh Flexi Cap fund's ability to handle tough market conditions well. Alright, so far it is clear that Parag Parikh Flexi Cap fund has demonstrated greater consistency in long-term performance. Although both Parag Parikh and HDFC Flexi Cap funds exhibited higher risk in terms of 5-year rolling returns, extending the investment horizon to 7 years reveals that Parag Parikh fund experiences lower volatility compared to both the category average and its peer. Moreover, it has navigated challenging market conditions more effectively. Next, let's try to decode the reasons for their performance by understanding their investment strategy. We will do this by looking at their investments and portfolio allocation. Let's talk about the most interesting data first. The chart on your screen shows the monthly cash holdings of two Flexi Cap funds. Parag Parikh Flexi Cap fund has been increasing its cash holdings since the end of 2021. At that time, only around 3 to 4% of the portfolio was held in cash. In contrast, currently, the fund holds 23% cash, which is almost one-fourth of its portfolio. The HDFC Flexi Cap fund has also raised its cash positions. At the end of 2021, the fund held 3 to 4% of the portfolio in cash, but currently the holdings are higher at 10%. The difference in category is clear. Parag Parikh is cautious and value focused, while HDFC likes to remain invested. Next, to understand how the funds invest and manage money, we examine their asset allocation among large, mid and small cap stocks over the last 5 years. This helps us to understand the change in allocation patterns of these funds. Well, both the Flexi Cap funds have heavy large cap tilt. Let's examine how HDFC Flexi Cap's portfolio allocation has changed over the years, especially since the fund manager changed 3 years ago. Over the past 5 years, the fund has kept its large cap exposure between 70 and 86% and averaging around 78%. In the past year, the fund manager reduced large cap holdings by 10 percentage points from 83% to 73%. At the same time, the allocation to small cap stocks went up from about 4% last year to 10%. On the other hand, mid cap exposure has dropped quite a bit, from 16% in July 2022 when Ms. Roshi Jain took over to a steady 4 to 5% since December 2023. Now, let's talk about the Parag Parikh Flexi Cap fund. The chart here tells an interesting story. Over the last 5 years, the fund has clearly increased its large cap holdings while cutting back on mid and small caps. Since November 2022, the fund has consistently remained close to 60% allocation to large caps. Meanwhile, its exposure to riskier mid and small cap segments remains very low, hovering just around 2 to 2.5%. But that's not all. What truly sets the Parag Parikh Flexi Cap fund apart is its significant allocation to overseas stocks. According to the portfolio data for April 2025, the fund currently invests around 10% of its assets in international markets. This includes prominent giants such as Meta Platforms, Alphabet, Microsoft and Amazon. Okay, so far we have compared HDFC Flexi Cap fund and Parag Parikh Flexi Cap fund. It's clear they have different investment and allocation styles. One last thing to help us understand the investment style and portfolio management of these funds is their portfolio turnover ratio. For those who are unaware, our portfolio turnover ratio tells us how often the fund manager buys and sells stocks. A ratio of 100 means the complete portfolio was changed over the past year. So, we looked at the monthly portfolio turnover data for the last 3 years for both funds. HDFC Flexi Cap fund has an average turnover of about 35%, while Parag Parikh Flexi Cap fund is a bit lower at around 27%. Now, neither of these numbers is a red flag. In fact, they suggest that both fund managers tend to stick with their investments and follow a buy and hold strategy. So there you have it, a detailed face-off between the two titans of the Flexi Cap category. While HDFC Flexi Cap fund brings legacy, size and strong short-term performance under its new fund manager, Parag Parikh Flexi Cap fund impresses with its consistent long-term track record, lower volatility and a more global measured approach to portfolio construction. While HDFC's recent performance is surely impressive, the long-term data still favors Parag Parikh's Flexi Cap fund. Ultimately, both funds cater to different investor preferences. If you prefer a value-driven approach with global investments and don't mind the fund manager taking huge cash calls, Parag Parikh is for you. Roshi Jain invests in fewer stocks comparatively, which requires very high conviction. According to a recent interview, Chirag Settlewad, head of equities at HDFC AMC, also mentioned that Jain's strength lies in managing concentrated portfolios. Now, in comparison to Parag Parikh's Flexi Cap fund, you can say that this approach is a bit aggressive. However, when it works in favor of the fund manager, it can yield great results. So, if you prefer a fund manager with a high conviction, slightly more aggressive approach, and someone who doesn't take significant cash calls, HDFC Flexi Cap can be an option. And with this, we have come to the end of this video. I hope you found this analysis useful. And if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.